Hi, I'm Toby.
And I'm Nick.
And welcome to the Pure Property Podcast, where we talk about all things property and property investment. The aim of the podcast is to provide bite-sized chunks of our industry insight and knowledge to help you invest intelligently. So first one of the new year, Nick, a little bit different. Usually we're in the office facing each other, but today, obviously, due to lockdown 3.0, we're actually doing this remotely.
Yeah, so a bit of a change for us, but hopefully all the technical issues work out well. Yeah, as you say, really good to be back doing a podcast again for 2021, and hopefully there's going to be plenty more to come this year.
Yeah, good one to kick off this week as well. And obviously we've had some promising news, even though we are back in lockdown. It's promising to see obviously the vaccine being rolled out. We've had the Brexit deal since our last podcast episode, so things are looking to be heading in the right direction this year. So fingers crossed, we will be back to some form of normality at any time soon.
Yeah, certainly. So, as you mentioned, a lot of people will be coming back to the market at the moment. I think the Brexit trade deal was a big confidence boost for a lot of people, just creating a bit of certainty and some kind of pathway into the future of how our relationship with the EU is going to be. And of course, you've got the vaccine rollout as well. So, whilst not every investor is going to be, diving back into the property investment market, we've certainly seen an uptick in inquiries, especially from overseas. So looking forward, hopefully that's going to continue. And a lot of people will be thinking, I've got this capital set aside, I've got a deposit, I've got, 50K, for example, to invest. How do I actually go about that? So, yeah, exactly. What we're going to do today is talk through how we could potentially invest £50,000 through Track Capital and get the most from your funds, basically.
Yeah, definitely. I think what we'll do today is because we looked at the average pot of money that most investors have, and that's why we've picked 50K mark. And also, what we're going to do is we're going to obviously tailor this at sort of a limited pot that you would have there. So, if you didn't have an abundance and vast supply of money, you've got a limited pot of 50K. How would we invest it, and how would we help you invest it here at Track Capital? So, yeah, that's what we will be going through. I mean, probably best to start with why property, because there are many other things that you could invest your hard-earned cash in. Obviously, here at Track Capital, we're focused at property. So the reason we obviously are advocates of property investing, and there's multiple reasons why. One being you can leverage using a mortgage. So obviously this helps minimize your risk to some aspect. So you can put in less of the money. So for example, if you have a property where it's worth 100,000, you only need to put in 25K as a deposit to purchase that property. So again, you don't have to be stumping up the full 100K, which can help minimize risk. Obviously, you do have the fact that you would have a mortgage on that. So just bear that in mind, because that comes with a risk in its own sense. But that said, lenders now are quite strict on criteria and their stress tests. So if they're happy to lend on it, that can obviously give you some confidence there. The other reason, I suppose, proven track record. Property, we've got years and years and years and years of data going back a very, very long time. And the one thing you can see is property is very robust over the long term, and there is a consistency in an upward trend in prices. Yes, you have peaks and troughs, of course, but over the long term, those prices are always steadily increasing, which is always good.
Yeah, absolutely. I definitely agree with that. I mean, it's one of the fortunate things about working in the UK property market. It's obviously one of the most well-established, robust legal systems and extensive track records of many cities and countries out there. So, yeah, it's really, really important to take a medium to long-term view of the market. Not how it's going to perform over the next year or two, but, how is it going to perform over the next 10, 15 years, and how has it performed over the past 40, 50 years? It's almost comparable to the stock market. I mean, a lot of people, when they're looking at the stock market, they have the impression that, it's volatile. There's lots of ups and downs, etc. Companies go through, successful phases and then downturns depending on millions and millions of factors. However, if you do look at, the S&P or the FTSE over the long term, there's also an upward trend there, and why it sees so much demand. So I think it's important to do the same in the UK property market. But yeah, leveraging with finance and having that long track record of strong performance is certainly a couple of reasons why we would recommend it.
Yeah, then you've got obviously property provides monthly income, which can be passive, of course, which is always a benefit. The capital growth factor, as we touched on, regards to prices. Now, capital growth can be an excellent way of recycling cash or building that pot back up quite quickly to reinvest, as many people have seen previously in the past. And also the fact, which is linked to supply and demand, is land is finite, so there's only a limited supply and there's only so much we can build. So in terms of the supply, it is always going to be limited to some extent, and obviously we know supply and demand is a massive factor when it comes to prices, which then goes back to that capital growth and upward price factor there. But I think they're definitely sort of, in brief, the advantages of property investing. And then, like we said, this is going to be tailored to how we would be assisting an investor, or how we would be investing this 50k if it was us here at Track Capital. So we are going to focus on a specific type of investment based on having a limited pot of £50,000. So, Nick, what would you be choosing as the type of investment to go for?
Yeah, I mean, firstly, just before we go for our recommendation, that's a key point there. There are plenty of property strategies out there. Buy, refurbish, refinance, rent to rents, doing refurbs in general. There's plenty of things that we can do, but ultimately, we're looking, how can we generate the strongest return on a 50k investment over the medium to long term. So with that in mind, and fundamentally what we do at Track Capital is help people invest in off-plan property, and that's exactly what we would recommend you do. Going for a city centre residential apartment in a high growth city where we're likely to see decent capital growth and appreciation over the long term. So yeah, putting it into an off-plan development would certainly be a great suggestion in our minds. Now, how do we go about doing that? Firstly, or one of the reasons why you would want to do that is because we're going to potentially buy in at a discounted price. We're buying at base pricing direct from the developer. We have done another podcast on off-plan investments, so do go and check that out. But to summarize, you're buying at a reduced rate because you're buying in advance and you're buying during the construction period, which potentially carries a bit more risk. Secondly, if you're working with a quality partner that's sourcing developments and has a strong working relationship with quality developers, you should actually be able to secure property at a discounted rate, even in comparison to other off-plan projects as well. So a really, really strong opportunity to get in at a lower entry level, which will far outweigh any rental income that you might get from a complete property for a 12-month period, for example.
I suppose it's effectively instant equity as well, just getting that discount. As we always say, or as people say in property, it's the price you buy at, not you sell at, is where you make your money.
Absolutely. So it's, getting in at that discounted rate, you already know you've got a margin of profit there effectively. And that's what we mean by when we say, equity. And then, of course, you've got the chance to benefit from the growth during that construction period. So ultimately, what you're doing is putting down a deposit, and you're getting the growth from the full property value, even though obviously you haven't purchased it outright. So going in at a discounted rate, getting that instant equity and then benefiting from that growth during the construction period will put you in a really, really strong position to get, decent appreciation over the long term. And then just a couple of spin-off factors from that as well. You're going to be able to pick out the best units in the development. When we're buying in apartment buildings, we want to go for something unique. We want to have some form of USP. So we're going to minimize void periods and see strong tenant demand. We're going to see strong resale values if we've got some, a balcony, a quality view, a corner unit, a duplex apartment, etc., etc. So yeah, there's a couple of points to think about as well.
Yeah, I suppose that's a very good point there. The choice is excellent. The earlier you get in, the more choice you have, which can, especially if you're looking at a block of apartments, sometimes, especially when you're thinking long term, if there's that one apartment that's got the best facing aspect, and maybe there's only a couple of two beds with balconies, for example, little factors like that to help not only with the rental demand, because you can kind of charge a premium for that, and it's not just the same old in the block, which can attract tenants and help them to pay more. And also, when it comes to selling, if you've got the only apartment in the block with a certain type of view, that is something special when you come to sell. So again, it can help sell and help you get a premium price for that property. And I suppose another aspect as well is you have the chance to buy parking and other aspects like that, which when you're looking at an apartment at city centre as a resale, um, if they haven't got parking, that's it. You've got no other choice. You'll be buying a two bed or a one bed without any parking. So I suppose there's little factors like that, which yeah, good point actually, Nick. When you're buying earlier on, the choices are a lot better and can definitely help in the medium to long term.
Yeah, and I think that's one of the reasons why it is worth focusing on off plan and why we suggest that specific strategy with the 50K. Because, if you could buy a freehold terrace house, for example, there's going to be thousands of them on the market for investors to purchase at any one time. Whereas if
Mm.
you've got a unique unit, you've got parking, you've got a real USP, you've got proven tenant demand, etc., it's going to be really appealing in the long term. So buying in at that discounted rate and then making sure we're retaining and increasing that value.
That's a very good point, because if you think as well, if you look at busy markets such as what we are experiencing in the north with your Manchester, Liverpool, Leeds, etc., you have to remember these houses, or even the secondary market apartments that are going to market. They have a lot of eyes on them. So the demand is massive, which then pushes up that price. You end up getting into bidding wars because multiple people are viewing and bidding. You've got people that want to live in it themselves that will pay more money. You've got investors that are scrambling over it. So that can sort of cause you to sometimes overspend in some instances. Whereas in the ones we're dealing with, they're off plan, and they tend to be off market, or they won't have as many eyes in most instances looking at them, which again helps. You're not getting caught in bidding wars. You know what you're paying for the property. It's a lot more straightforward that way.
Yeah, definitely. I think one of the things that a lot of investors, even our investors, to be fair, aren't always aware of is that developers do place restrictions on marketing these developments. So yes, you can put generic adverts on Google, etc. But a lot of probably 8, 9 out of 10 of the developments that we market, you can't actually put adverts on places like Rightmove and Zoopla, etc., etc. So it just makes gives us the opportunity to limit the extra competition, as you say. So yeah, plenty of advantages of off plan there, but the main one is over the long term you're going to make a strong return on that original 50K. So with that in mind, and I think we touched on it a bit there, Toby, what do you think about locations and where to specifically buy?
Yeah, location is going to be important, especially if we've got this limited pot of money, because we're going to be wanting to look for somewhere where capital growth potential is strong, and also where there's going to be demand as well, which it probably goes hand in hand. If you've got capital growth potential there, it's going to be due to demand, both rental and sales, so that's good. So for example, if we had an investor in front of us today, we would be going probably with well, our top two, I would say at the moment, are going to be Manchester and Liverpool. And the reason we would be leaning towards those is because we are trying to focus on that capital growth aspect quite a lot. So we want to look for places where there is a track record of it, where we know it's more than likely going to happen, where we have seen sort of prices rising there already. So we would be looking at the data, and yeah, the front runners are Manchester, Liverpool. Nottingham's also another one, but if we're looking for real good solid ones, then Manchester and Liverpool is where you're going to be looking at. And of course, research is key when it comes to this. We will do a lot of research, obviously, for our clients, but we always recommend that they do their own research and look over our data research as well. For example, if you look on Zoopla, recently they will be saying that Manchester has had a 27.18% house price growth over the last 5 years, which equals around you're looking at 40, just over 43,000 as an average there, which is excellent. So we can see there's a great track record there. Price have been doing well. We know the regeneration development going into Manchester. So again, these are great fundamentals which are pointing towards capital growth to carry on. We can also look at the recent house price indexes. So Home Track, for example, their latest report, they stated that Manchester, I believe it was around 5.7% year on year, and that was in November's figures. So again, we can see not only has it had the consistent capital growth, it's carrying on. We know the fundamentals, like we mentioned, of regeneration development are still going on as well. So that would give us a great benchmark to say, yes, this is one of the places that we need to be looking at to get your 50k into and really capitalize on.
Absolutely. So it's worth considering. Yes, we want to go for capital growth and places like Manchester and Liverpool with our £50,000 budget. The whole purpose we want to go for those, top tier cities is so we see the capital growth and then we can potentially withdraw the equity that we've built up, recycle those funds, which we'll speak a bit more about later, and put them into another, property investment. So yes, we could look at cheaper cities like your Stokes, your Hulls, your Bradfords, your Burnleys. You might be able to get 2 freehold properties with that 50k deposit, but ultimately it's going to take you really, really long to get that equity in the property because the capital growth is more limited in those cities. So it could take you longer. Whilst you may get a higher rental yield in the short term, it could take you longer to build that portfolio because we're not getting the equity there.
That is a very good point. Obviously, the yield is obviously great, but it drip feeds in. It takes, like you mentioned, a while to build up a good pot. It can take many, many years, which isn't a bad thing. Look, it's great to look at yield because that is a monthly income. But that said, like we said, if we really want to be growing this portfolio well and quickly, and in some instances aggressively, the best way to do that is getting a big chunk of money to draw out of the property you've just invested in. And again, the quickest way to do that in this instance would be the capital growth.
Absolutely, absolutely. So, I mean, when we're looking at what to buy specifically, in most cases, what we're going to say to people is, go for a city centre property. This is where, as we touched on, the investment fundamentals are. So, major employers, big educational institution, strong transport links, good education, etc., etc. So, once we have those things in place, we know that the demand for the property is likely going to be there. And if it is in the city centre, it's more than likely going to be an apartment. So yeah, we would say, stick to city centres and go for a high quality apartment that we think is going to be in demand.
Yeah, of course. I mean, like you said, they're going to have demand in both rental and sales. So that's obviously gives you the highest chance of consistent rental income and also price increases there as well. And again, the quality has to be good. You want to be looking at good developers, good builders, good specs, good finishes. These are sort of little factors which all help.
Yeah. So with that being said, then looking at the different factors, we've got 50k there. We want to grow a portfolio over the long term and really build some wealth. So we want to go into a quality off-plan development, get an apartment which is has a USP. It's really unique. It's going to attract tenants and future buyers. We're going to buy in a city with really, really strong capital growth potential, so we can potentially withdraw funds at a later date and buy a new property. And then, of course, we want to make sure we're getting a quality product and a really strong finish from a good developer and a good builder. Leverage with finance to buy that property, and benefit from strong growth during the construction period. So, with that all being said, then I think what we do now is move on to a specific example, so we can see how our strategy works in terms of real life finances and how we're going to use this deposit pot to potentially build up a portfolio over the long term. So, Toby, you're going to run us through the numbers on this one, I believe.
Yeah, we're gonna call this strategy complete and repeat.
Nice catchy name.
Yeah, I think that's going to catch on. Actually, I have to use that more often. So let's say we're looking at an off-plan property. It's 12 months off completion. We're securing a conservative 10% discount, which is very realistic. We tend to get more, but we're going to do these numbers quite conservatively, just to make it sort of very realistic. So 10% discount. So let's say we found a property. It was 150,000, if that would be sort of the open market value in today's money. Yet we're buying off plan, so of course we've got that discount there, 10% off that purchase price, which means we're buying at 135,000. So we're going to secure that property, and how are we going to do that? We're going to put in our 30% deposit that will secure that property at that price. So the developer can't turn around to us in a year's time and say, I'm really sorry, but prices have jumped up massively. I'm going to have to charge you more money. No, you've exchanged contracts. You are legally obliged to sell it to us at that excellent price we've got. So that 30% deposit on 135k, that's going to be 40,500. Now, when we factor in your stamp duty, legals, and you might want to put a very nice furniture pack in there, you'll be looking around 50k, probably slightly under, but let's round it up to 50k. So that's your 50,000. That's all in. Now, 12 months later, you complete on the property and you get a tenant in and you rent it now for the following 2 years. Since you secured your investment, prices have increased 4% year on year. So from the time that we secured the property at that price to the completion, and then 2 years later, since we've been renting it out, that will be 3 times 4%, which gives you 12% capital growth. Now, remember, that 4%, I am being conservative. The prices I'm discussing, these are realistic prices in Liverpool. Savills have forecasted in Liverpool over the next 5 years 27.3%. So that's just over 5% growth averaged over the 5 years there. So we know 4% is realistic. So 4% growth over 3 years, that gives you a total of 12% growth. Now, so we're going to sit there and say, well, how much is our property worth? What can we do here now? So the market value when you secured it was 150. So that was 3 years prior. So plus the 12% increase in prices, you'll now have a property valued at £168,000. So you're left with around £33,000 equity, which is excellent. That's a big pot of money you've now got there. Over the 2 years, let's say you've been averaging £400 per calendar month net rental income. That will give you a pot of money at £9,600. So the 9,600 plus the £33,000 equity, you're now looking at 42,600, which is your deposit for another property. Obviously, that is simplified and obviously realistic in terms of the figures as well. So it gives you a great indication of how you can recycle that money, pull it back out and reinvest it, which again, I think a lot of people don't necessarily see. They think they've got 50k and they can't do much with it and there's no chance of them building up a property portfolio. Well, we've just proven you wrong there. The complete and repeat formula does work.
Okay, brilliant. Yeah, hopefully that was really helpful then for our investors, and I'd agree. I think they are conservative figures. Yes, they might vary slightly depending on the level of funds you can withdraw from the property, etc. But the idea is to give our listeners and investors an overall and explain the power of what can happen when when you recycle your cash effectively. And ultimately, it's not going to take you long. You do 3-4 of these, you've got a substantial property portfolio there. So yeah, really exciting stuff, and a strategy we're looking to implement personally as well. The only thing I'd add there as well is with regards to the additional costs. So obviously we have our initial 30% deposit in that example, but then we've also got things like stamp duty, furniture pack costs, and legal fees as well. Now, where Track Capital can really add some value in financial sort of terms is in some cases we can pre-negotiate deals with developers where we might take on 100 or 200 apartments for sale, and the developer will say, right, based on your buyers purchasing earlier on in the sales process, we will provide a stamp duty contribution. So this might be, 50% of your stamp duty covered, or in some cases, like one project at the moment, we can actually have your full stamp duty bill covered, whether you're a resident or non-resident, and have that completely paid off on your behalf. So there's potential savings there of up to £20,000. Now, you might ask, why would developers potentially do this? Well, in a lot of cases, they've got hundreds of units to sell. They want to be competitive. We've got COVID, we've got Brexit at the moment going on. So it's a really, really good time to squeeze extra incentives out of developers. This can be through the form of stamp duty, as I mentioned, but also things like free furniture packs we can negotiate. So you can get that property looking, like it does in the CGI images. You can imagine a tenant walking into a brand new property, completely brand new furniture for our. We're going to be able to charge a really, really attractive rental price for the landlord. And then finally, legal fees as well. We can work with developers to get contributions on that side and potentially cover those for you. So, it's worth considering comparing to go and buying a property on Rightmove. If you can get incentives across these three areas, you can really, really save yourself up a significant amount of capital, again, going to that pot in the future. So hopefully that all makes sense and is summarised nice and neatly for everyone to understand.
Yeah, no, great point there, Nick. But yeah, excellent. And yeah, like you mentioned, those incentives can save our investors a lot of money. But yeah, hope that was very insightful for you and hope it helped. If you do have any questions, obviously, always feel free to reach out to us. We're always a phone call or email away. Next week's episode, we're going to be talking about whether it's best to buy and invest now or wait to see what happens. So yeah, going to be a good one for next week. So make sure you tune in. That's it from us this week. Thank you for listening, and we will see you next time.
Thanks, guys. Bye-bye.